Our guest is a commodity watcher who says there are signs the world is inching towards a wartime economy when it comes to natural resources. Let's get more from Bart Melek, Managing Director and Global Head of Commodities Strategy at TD Securities. Bart, great to see you. It does sound alarming. And what you mean is nations are furiously stockpiling commodities in many cases?
I think they are, particularly in the U.S. I'm not sure that is always a conscious effort. But as we look into next year, I think there are many players out there who believe that we could see even higher tariffs or more broad tariffs in the commodity space, and that is incentivizing all sorts of hoarding. I think today's price action on silver is testament to that. We've seen copper at record levels. We're seeing aluminum surge, and all that is happening at a time where the fundamentals aren't necessarily as supportive as the recent price action would support. And of course, there is the Federal Reserve that we're looking at, tomorrow to see another cut.
But that's interesting. China, we know, has been building up vast amounts of oil, maybe simply taking advantage of low prices. But and certainly President Trump determined to ensure that America has supplies of these vital metals, even if it takes years to create domestic production.
I'm glad you mentioned oil here, and that is a big case in point. You have agencies like the IEA, the International Energy Agency, and others who are predicting massive surpluses in the new year, certainly in the first and second quarters. Yet here we are, under $60, but nowhere near low 50s or high 40s. And part of the reason is that China has been stockpiling a lot in its strategic reserves. And, we think that going forward next year, we're going to see as much as 1 million barrels per day of increases in their inventories, which is going to mute a lot of that negative aspect, and we're seeing positioning really short. So oil could surprise to the upside. In fact, we think we're going to get a bit of upside in the latter part of next year.
That's interesting. So for oil, give us that thesis again. You do see a potential rebound in oil, Bart? Because for one thing, you note that the U.S. rig count has been dropping steadily.
They have been, and we haven't seen as a robust impact as normally, particularly in the shale regions, as rig counts have dropped. And they have dropped, I think, north of 50 rigs. That's substantial. My hypothesis is, and this is what I've talked about at our TD Cowen conference, energy conference, just a few weeks ago, that we will likely see sub-60 prices in the early part of the year, and that is going to incentivize a lot of companies who gave positive guidance on production to maybe pedal back. So we might see declines in shale production. We're going to see a peak in non-OECD, and for what it's worth, we believe that the International Energy Agency is probably a little bit too optimistic on the supply side and too negative on the demand side of the equation.
We're looking at spare capacity here, a metric of TD Energy supply risk factor. And obviously that risk factor plunged during COVID. There was plenty of oil. Nobody was driving. But the OPEC spare capacity has been dropping.
It has, and traditionally that means that any time that happens, something bad happens in the world, that risk premium is higher. And what are the bad things that could happen? At this stage, we don't think anything in the Middle East in terms of a conflict. I think that's probably off. But we're certainly having issues with Russia. We've seen the last time I counted, we had at least 3 tankers being damaged by Ukrainian drones. Insurance rates have skyrocketed for that shadow fleet, and we could probably see more of that happening as the negotiations heat up, and everybody's going to try to get advantage. So that is one aspect. We're already projecting 300,000 to 500,000 barrels less from Russia, but that could be materially more.
We haven't got much time, a bit more than a minute. Copper, you note that American data demand is going to be a huge part of their electricity consumption, even compared with global benchmarks. the green line there is America, and the black line is essentially just a bunch of small countries. So America is going to need vast amounts of data centers, and of course that means copper, doesn't it?
It very much means copper, but not where you would actually think in the data centers itself, but more in the transmission side of that generation equation, in the transportation of energy, the step down transformers rather, switchgear and others. That's very copper intensive. But the real story, an interesting story that I think has been neglected, is natural gas. Globally, we're going to see some 500 terawatts of new consumption in the next 5 years. Half of that is going to be natural gas, and we calculate that could be of upwards of 4 BCF per day of extra demand. And we're not quite sure where that supply might be coming from for natural gas. And look at natural gas now.